Hi everyone, Nick here, welcome back. I-bond rates are crashing. 6 months ago, you could buy an I-bond yielding 9.62%. Then it dropped to 6.89% November 1st. Now we've learned after May 1st, the I-bond inflation rate is dropping to 3.4%. Some of my friends and family are still asking me if now is a good time to purchase I-bonds. It was an okay run while it lasted, but I think now it's time to start considering selling I-bonds. In this video, I'll explain why you might want to sell I-bonds, some possibly better alternatives, and how to estimate the break-even point if you pay the penalty to sell I-bonds and buy an alternative like a treasury bill or TIPS bond. Why do people buy I-bonds? The primary reason is inflation insurance. The biggest group of people that probably want this type of insurance are retirees. They're living on a fixed income, and they want their spending power to be equivalent in the future. They don't want a lower quality of living if we have high inflation. They want some protection against that. Now, luckily, in the US, we have Social Security, which provides a high degree of inflation protection. But a lot of retirees want some extra assurance on the additional spending they have over Social Security. For these people, it often makes sense to buy I-bonds or possibly TIPS to get inflation protection so they can guarantee that level of spending. Another group of people that may have bought I-bonds recently is just average people that were afraid by what was going on in the market. Last year it dropped 20% and I-bonds were yielding 9.62%. It looked pretty attractive to many people. I heard a lot of people talking about buying them even though they had no interest in the inflation protection. Just looked like a safe place to store cash for a bit. Now, both the retiree looking for an inflation protection, people just seeking the best yield currently, both have reasons to reconsider holding I-bonds, given changes in the market and the I-bond rates. For the retiree, TIPS are actually offering better inflation protection right now. For people that weren't really looking for the inflation protection and were just buying I-bonds because of the high rates, we're now seeing alternatives like T-bills or CDs that are offering competitive or possibly better rates than I-bonds. Both of these groups of people might be thinking, when should I sell my I-bonds? How much will it cost? And so forth. We're going to get into how to calculate that break-even rate. In order to calculate the break-even rate, we need to understand how I-bond rates are calculated and what the rates have been recently. So remember, I-bonds have a rate that is composed of two parts. First is the fixed rate or the real rate, which doesn't change for the life of the I-bond. And then you get the inflation rate, which changes every 6 months. So every 6 months you get paid interest, which is the fixed rate plus the inflation rate. You can roughly double that to get the annualized rate. So if you bought an I-bond in November 2021, the fixed rate was 0 and the inflation rate was 3.56%. And then in May 2022, the inflation rate went up to 4.81%. So your annualized rate of return would have been about 8.54%. Or if you bought between May 2022 and October 2022, your first year return would be about 8.21%. Then rates went down to 3.245 for the inflation component in November 2022. Now, people who bought November 2022 or later got a fixed rate of 0.4%. So I have that in a separate sheet. Just to keep it simple, I've divided that in 2 for the 6-month rate. So people who have bought since then will see a return of about 5.41% for the first year of holding through October 2023. You can still buy I-bonds right now at this rate before May 1st and lock in this 5.41% return. That's actually pretty good. But if you were to want to sell that and redeem your money, you have to pay a 3-month interest penalty, pay a penalty of 3 months of interest. After paying that, you would get about 4.43%, which isn't as attractive as some of the other rates on the market currently. So you would buy a 1-year treasury for 4.75% yield, which is much better than 4.43. And it's a bit more liquid than the I-bonds. You can actually sell it earlier if needed, or I-bonds you do have to wait the full year. All right, so going back, we have basically two groups of people. I mean, people who bought I-bonds a really long time ago, like 10 plus years ago, might be a different group of people that have even better fixed rates. But if you've bought in the last few years, fixed rates were basically zero for quite a while, especially recently before November. And then in November, they went up to 0.4%. So we're going to use these two groups of people to look at the break-even rate. So if you bought when fixed rates were zero, from November 2022 through October 2023, your return will be about 5%. Now, as we just saw, rates for a one-year treasury are just below that. So it's still decent. However, if inflation continues to trend down as only 2.8% going into the next rate adjustment in November, your yearly return from May 2023 through April 2024 is only going to be about 3.12%, which starts to look a lot worse than what else is on the market currently. Now, it's a little better if you have the 0.4% fixed rate because you'd be at 3.53%. I'll show you how I'm estimating the break-even rate. This is if you're going to sell the I-bond now, pay the penalty, and invest it in something else. If you bought I-bonds more than 5 years ago, you don't have to pay a penalty. So the break-even rate's basically, can I just get a better rate on the market now? And do I want to keep the inflation protection that the I-bond provides? Or is there better inflation protection from another product like TIPS? But for people who have to pay a penalty, this is how we can roughly estimate the break-even rate. So if you bought November 2021 with $10,000, it will grow to roughly $11,206 come May 1st. At which point you have two options. You can continue to keep the money in the I-bond, and if our projection for the November inflation is roughly accurate, you should have around this much left at the end of that November cycle come May next year. So if you were to leave the money in for another year, that's a rough estimate of what you would get. Now, if you sold it early, you would have to pay a penalty of the last 3 months of interest, which is $176. So by using this rate formula from Excel, we're estimating the rate you would need to get to this same amount of value after 1 year if you were to sell this May 1st and transition to something else. So that would be 4.77% if you bought an I-bond in November 2021 or even May 2022 at the 0% fixed rate. For someone who bought it at the 0.4% fixed rate, it's a little higher because you also have to make up for that 0.4% rate. So there you could sell the I-bond and pay the $172 penalty, but to reach that same level after a year, you'd need 5.28%. Now that rates are lower, you could instead wait 3 months from now and pay the penalty on these lower rates, which would nearly cut your penalty in half. And that lowers your break-even rate. So 3 months from now, if you were to sell, you would need a 4.16% annualized return over the next 9 months to reach this same value you would get from keeping it in the I-bond. And at the 0.4% fixed rate, it's also a little higher at 4.7%. Now that we've looked at how to estimate the break-even rate to exit I-bonds and buy an alternative, let's take a quick look at what those alternatives are. We looked at this briefly before, but for treasury yields, they're pretty good right now on under 1 year yield, at nearly 5% on a 1 year and roughly 5% on a 3 month or even a 6 month. Then as you extend out to 10 years, it goes down to 3.5% or a 30-year 3.7%. And treasury inflation protected securities are also pretty attractive right now. The I-bond has the fixed rate of 0.4%, and TIPS are actually paying 3 times as much as that on the 5-year, and a little over 3 times as much as that on a 30-year or a 20-year. So I'd actually, if I were looking for the inflation protection, I would strongly consider TIPS. For a while there, TIPS yields were actually negative. You can see this on the Federal Reserve's website. This is on the 5-year TIPS bond. you could actually see it was negative for quite a while, and now tips are back up to attractive levels where it's actually positive. Obviously, it would have been a much better time to buy an I-bond when tips rates were negative, but now that tips rates are positive and quite positive territory, it's much more attractive. And historically, we can see that it's actually at a pretty high rate historically. We haven't really had rates this high on tips going back to about 2007. So if you're really looking to buy inflation insurance is a pretty good deal in tips right now, in my opinion. At least compared to historical prices, they're pretty good. So let's review what we discussed. There's a couple types of people that have bought I-bonds. There's people that want inflation protection. For those people, I-bonds are still a decent deal, provided inflation protection, and they have a couple other benefits like a little bit of interest rate protection, just quite minimal considering the purchase limits, and the fact that they also protect against deflation. You can't lose principal value in an I-bond. However, tips are yielding 3 to 3.5 times on the fixed real rate of return compared to I-bonds currently. This is very attractive if you want inflation insurance. You're getting far more in tips right now than you are in I-bonds. I think they're much more attractive for people who want inflation insurance. And for the other group of people that may have just bought I-bonds because they had such historically high rates while the market was very volatile, now you're in a little bit of a tough spot because the I-bond rates are dropping, and you might be paying for inflation insurance when you didn't really want it to begin with. You were just trying to get the high rates that they were yielding for a bit. Now, for both these groups of people, we looked at how to estimate the break-even rate. If you sell the I-bond now, pay the penalty, and transition into something different. So I'm really interested to hear what you think about the I-bond break-even rates. Are you considering selling I-bonds and transitioning to tips or something else? Or are you going to hold on to the I-bonds and hold them for the long term? Either one could make sense depending on your circumstances, and I'm interested to hear what you think in the comments below. If you got value from the video, please hit the like button and subscribe to support free financial education. Thanks for watching, everyone. Later.